Hello, very good morning to all, and welcome to a brand new week ahead. And I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights by OANDA. And today's Daily Dose of Insights will be slightly different, as I'll be covering certain key US election insights, as we know that we are less than 3 weeks away from the 5th of November US presidential election. So very good morning to all. Today will be Monday, the 21st of October 2024. So before we jump straight into today's gist of Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Leverage trading losses can exit deposits, as well as this presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so I do mention that over here is that from today until the 6th of November, the Daily Dose of Market Insights will have a slightly different tilt where I actually include in some US presidential election insights, if there's anything very important pertaining to the respective market asset classes, and as well as the rest of the other we call it key agenda of the daily dose will remains the same. We will actually also cover, as usual, the short-term intraday technical outlook, and we will wrap up on the daily basis what are the key events or data to look out for today that could impact the various respective cross-market cross asset classes. All right. So let's start with what happened has taken shape over last Friday in terms of the news flow and its impact on the respective cross asset classes. So on last Friday, over here, one particular event I want to share with you is pertaining to the China stock market. So we know that 3 weeks ago or 4 weeks ago, the China stock market has a very sharp rally. This rally is driven by hopes of more physical stimulus measure that market participants has starts to price into the market. So what we could see on last Friday after the close of the A share stock market, that means the mainland stock market, China actually now announced much more concrete details, but more pertaining to the monetary policy side of the policy making process rather than the fiscal stimulus that market has been anticipating about fresh stimulus about 2 trillion to 2 trillion to 2 trillion to 3 trillion yen that is being expected to be pumped into the Chinese economy, but that has not been announced yet. So on last Friday is more pertaining to the monetary policy side of the story, where the PBOC, China Central Bank, actually announces the detailed swap and re-lending scheme to support capital markets. That means, i.e., the China A shares market. So enlarge it so that you guys could have a better view over here. So what's being announced over here is more detailed plan. Okay, let me go all the way down. Okay, so that is what I call re-lending scheme. That this detail of this scheme was not announced 3 weeks or 4 weeks ago before the China National Golden Break holiday. So basically, pretty much right now is that initially this re-lending scheme will be worth at the start of 300 billion yuan that allow financial institutions to borrow from PBOC. That means PBOC is like a main bank. They will lend out this 300 billion yen to financial institutions in China, be it brokerage houses or banks, to fund share purchases listed by listed companies or their major shareholder. So this particular 300 billion yen is indirectly used as a fund for share buyback. And also, net overall, the listed company and their major shareholders borrow from the banks, right? From the banks at interest rates up to maximum 2.25%. Okay, maximum 2.25%, which is very cheap in comparing to the current market rate that is prevailing in the China. We call it a loan prime rate. Okay, so if you look at the China loan prime rate, after today's deduction, which is came in with expectation. 1 year loan prime rate is 3.1%. The 5-year loan prime rate is 3.6%. So if you look at comparing to this so-called re-lending program rate, where listed company major shareholder can borrow from the banks, maximum interest rate charge will be only at 2.25%, way lower than the 3.1% and 5% on the loan prime rate that I shared with you earlier on. Over here, 3.1 and 3.6%, pardon me. So then overall, it actually lead to a positive feedback loop in the market right now. So if you look at it over here, is that the CSI 300 managed to actually rose up by 3.9%. So that is not a very fantastic move over here. Why? Because this particular policy is more pertaining to the monetary policy. So we know that monetary policy, if expansionary monetary policy by pumping in more liquidity into the economy or into risk asset like the stock market where I share with you in this re-lending program, but if it doesn't complement with physical stimulus policy, that could lead to a liquidity trap. Because right now, physical stimulus policy, there is still no we call it outright concrete details on any particular specific announcement done by the government, so-called state or any we call it official press on that fresh 2 trillion or 3 trillion stimulus plan that is widely anticipated by the markets 3 to 4 weeks ago. So that actually explains why the CSI 300 jumped by not a very high magnitude of more than 1%. It's only right now trading at 0.44%. And what we could see over here is a bit of a rotation play from the H shares, the HSCEI, the H shares that is down slightly negative 2.7%. And the HSI is down negative slightly 3.4%. So a bit of rotation play from the Hong Kong stock market being rotated into the A shares right now. So later I'll touch on the intraday technical outlook for the Hang Seng Index. Right, so these are the key we call it news flow and events that has taken shape on last Friday that I want to share with you all, pertaining more towards the China A shares market. So now back to some insights about the US presidential election. So we know that now we are less than 3 more weeks to go before the 5th of November election day. So by looking at the current betting odds right now, so this particular betting odds, some of you all may already known because I flashed this in my previous couple of weeks ago daily dose. So this is Polymarket. Polymarket is one of the major betting sites, and this data is live right now. It's speaking. So let me refresh it again. So what we could see over here is that based on the betting odds over here, Trump is actually leading quite a comfortable margin of more than 50%. So in terms of the betting markets over here, they are indicating Trump has a 60% chance of leading over Kamala Harris, which is slipped down to 39%. And if you look at the past trend over here, the past trend, so what you could see when Kamala Harris took over Biden, the betting odds was rather we call it neck to neck, and only in the recent last week, Trump has starts to widen the margin by 60% to against Kamala Harris 40%. So this is the live one taking from Polymarket. So there's, if we know that by looking at one particular betting site, the result could be skewed. So we could look at the average of betting sites in terms of this kind of we call it betting odds pertaining to the 5th of November US presidential election. We can go to this real clear polling website did. They get a average of various betting sites, including Polymarket. So there's total of 1, 2, 3, 4, 5, 6, 7 betting sites. They get an average of it, compare it across the board. So at least we know that it will not be skewed to one particular betting sites, which is Polymarket is the one that is I'm able to get a live update of this website, and it's one of the major one. So by looking at this average, we still see Trump leading by 57.9, slightly below the 60 by what the Polymarket is showing just now a while ago, whereas Harris is slightly up by 41. Okay, so 58 to 41. But bear in mind, this data is not live. So if you look at it over here, currently it's 2 days late. It's based on the latest data available of 19th of October. But the key thing I want to share with you all is Trump is actually leading by a significant, and his lead has started to widen significantly in the last 2 weeks or so. So what does it mean for the market? So we know that Trump himself advocate a very pro-business policy. That means he advocate tax cuts instead of hike. So he wants the corporate tax to be reduced from 21% to 25%. Whereas for Kamala Harris, she's actually not really that pro-business. She's more pro-middle class, and in fact, she wants to have increased the corporate we call it a tax rate from 21% slightly above to 28%. So net overall, what this partisan we call it guide pinwheel budget model. So what they did over here is that they based on whatever latest public speeches made by these two candidates, Trump and Harris, to come out how their particular plans in terms of taxes impact the budget deficit. Okay, so let me expand my screen so that you guys could see over here. Make it bigger. Okay, so what I could see over here is the Harris campaign policy proposal, PWPM. So this particular Penn-Wharton budget model estimate that Harris campaign tax and spending proposal will increase the primary deficit by 1.2 trillion over the next 10 years, and on a conventional basis by 2 trillion on the dynamic basis. All right, 1.23 trillion next 10 years and 2 trillion on the dynamic basis. Whereas for Trump, over here, Trump, the estimate would increase the budget deficit by 5.8 trillion, more than 4 times than Kamala Harris, and 4.1 trillion on the dynamic basis. So net, what I could see over here is that Trump's generous tax cut will potentially widen the US budget deficit much more significantly compared to Kamala Harris, we call it a budget proposal and his tax proposal, even though she wants to actually help the middle class. So since Trump is leading by a wide margin right now, market seems to be more concerned about this widening of this US budget deficit in the next 10 years if Trump were to actually win the White House again. So what does it mean for markets? So let me share with you one particular cross asset classes in today's US presidential election. Inside will be gold, XAU, USD. We know that gold market right now has been rising very steadily over the last 1 month. And in fact, while we are speaking right now, the gold XAU/USD managed to hit another record high in today's Asia session currently. So later I'll touch on more about the gold intraday technical outlook. So let me share with you this particular widening of this US budget deficit under Trump, potentially how it could impact the gold price. So what you could see over here is that this particular website I go, it's called Micro. Is a very particular website that able to us to plot macroeconomic data, overlay it with public traded asset classes like gold. So what you could see over here is on my chart, this little horizontal line is the US federal surplus or deficit. So based on the latest deficit as what compiled on okay, let me get out from gold. Okay, let me remove the public debt. Okay, from here. So I could see it's about negative 1.7 trillion of US budget deficit for 2023. This 1.73 trillion of US budget deficit 2023. So this data is not really that updated yet because on late Friday, the budget deficit actually widened to 1.8 trillion annual. Okay, so we know that annual deficit has started to widen on 1.8 trillion, way above the 1.7 trillion that was recorded previously. Okay, so based on this latest data, the US budget deficit actually widened the deepest in the rate as compared to the pandemic period where it was widened to negative 3 trillion due to very we call it a rampant fiscal stimulus measure that is being undertaken to actually counter the adverse impact of the pandemic. So with this widening of this US federal, we call it deficit, eventually it will actually increase the US total debt, public debt in percentage against the GDP. So net overall, with this widening of US federal budget deficit, together in terms of the public debt also widen in terms of percentage of GDP as well, that could actually see gold prices or supporting firmer gold prices going forward. Why? Because we know that an increase in the US budget deficit could potentially lead to more risk of government shutdown going forward. As we know that government shutdown, it means that the US government doesn't have enough funds to fund its so-called primary services. So that could also potentially lead to a risk of downgrade of US Treasury bonds, sovereign bonds ratings, all right, by the public, those we call it credit agency like Fitch. So that could actually see less, we call it potentially less demand for US Treasury US Treasury notes, and also could lead to see firmer gold prices, given the fact that there is a higher risk for holding US Treasury debt in this conduit of linkage. That means, i.e., higher budget deficit. Why? Because Trump is leading the betting market right now. If that's were to take place, gold prices will react positively to this particular news flow, and will actually reinforce this ongoing major trend that has been taken shape in the gold XAU/USD since October 2022. All right, so that is the key so-called US presidential insights that I want to share with you today, more relating to the gold market. All right, so right now, let us now look at one particular fundamental and inter-market dynamics, since we are talking about gold right now. So I will share with you all also pertaining to the gold market as well. So this fundamental and inter-market dynamics will last for a multi-week perspective. So let me open up this chart of gold over here. Okay, so what we could see on my screen at this juncture is gold XAU/USD. This is a weekly chart. At the bottom is the gold ETF implied volatility index, right? Implied volatility index. So I'll share with you all in the past few push up in gold price over here. So this was in April 2011 all the way up to October 2011 over here. Gold price push up, then before the gold price push up over here, we do see a spike up in the gold implied volatility index. So after that spike up over here, once is the gold implied volatility index starts to normalize again, we see gold prices starts to correct itself, all right, during this period in time from November 2011 all the way up to December 2015 over here. And at this juncture over here, we do see December 2019 all the way up to March 2020, there was actually a spike up in the volatility index for gold. So that was due to the pandemic crisis. So this spike up led to the push up in gold price over here during June 2020 to August 2020. Then after that, gold price starts to consolidate sideways. And this is where you start to see the gold ETF implied volatility index also starts to normalize on the downside as well. All right. So what's interesting, the current price movement over here. Okay, let me push it up from here so that you guys could actually see a better picture. Okay, so this is gold, and this is the implied volatility, the gold implied volatility. Yeah, the implied volatility of the gold ETF. So I could see, yes, we know that gold price has been rising very steeply since the low of June 2024. This is very steep over here, and this is the start of the major uptrend in October 2022 low. All right, this is the major uptrend that is still in place. So yeah, we know that gold has risen rather steeply on the since the low of June 2024. A lot of people may be asking, is this the circular top of gold? But if I look at the comparison on how gold behaves accordingly to the so-called in correlation with the movement of the gold ETF implied volatility index, so far we haven't seen a spike up yet in the gold implied volatility ETF. And what it starts to seem to tell us over here is that we start to see a series of rising higher low, okay, that has been in shape since October 2023 last year. We see a series of higher low, but gold price hasn't really spiked up yet at this juncture. So given that if gold price, no, pardon me, let me repeat everything. It's about tongue twisting. So far, we start to see higher low on the gold ETF implied volatility index, but it hasn't really spiked up yet over here, and since it haven't really spiked up yet on this gold implied volatility ETF, that means i.e. there is a potential chance that the gold XAU/USD price movement could potentially extend this current steep up move that is in place since 10th of June 2024, because the implied gold ETF volatility index hasn't spiked up yet to the upside. Only when it spikes up yet to the upside, that means there's a sudden spike to it, then we will be pretty much concerned about this ongoing impulsive up move in gold XAU/USD. Why? Because previous spike up in the implied volatility ETF, gold ETF, the implied volatility index of the gold ETF led to a significant multi-month consolidation in gold on the downside thereafter. Previously during the pandemic in March 2022, and also as well as in August 2011, where there was a spike up in the gold ETF implied volatility index. Then thereafter it led to a multi-month kind of a corrective decline in gold price. So at this moment in time, we do not see such behavior yet, only a series of higher low in the gold ETF implied volatility index, but there is no spike up yet in the gold implied ETF volatility index, which actually potentially supports this ongoing impulsive up move in gold XAU/USD. All right, so that is the intermarket and dynamics that I want to share with you all for today, for more of a multi-month, multi-week to multi-month perspective. Okay, so now with that, let us now straight away jump straight into the short-term technical outlook on the various cross asset classes, purely on the technical analysis perspective, looking from a period of 1 to 2 days horizon only. All right, so with that, let me expand my screen so that you could actually focus more clearly on the charts and its key respective level. All right, here, good. My screen is open. So let's start with the FX market first. Okay, let me expand the screen. Starting with the euro dollar. So before I jump into the hourly chart of the euro dollar, let me share with you all this particular key chart, the daily chart of the euro dollar. Why is it important? Because we know that from the 25th of September all the way down to last week, these 3 weeks of decline has come close to a major symmetrical triangle lower boundary. Okay, so this major symmetrical triangle is in place since the high of 18th of July last year. Okay, it's trading in a symmetrical triangle, and that 3 weeks of decline came close to the lower limit of this major symmetrical triangle lower limit, which is also our medium-term pivotal support that we predefined at 1.0780/1.0750. And what happened to its daily RSI indicator, momentum indicator? It managed to exit from the oversold level, so indicating that 3 weeks of decline has really reached a oversold region. And importantly, the Bollinger bandwidth also starts to raise significantly as well. A rising Bollinger bandwidth that has risen significantly indicate that these 3 weeks of decline from the 25th of September high has also reached a overstretch condition. So with an overstretched condition and an oversold condition on the daily basis on the euro dollar, coming close to a key medium-term pivotal support at 1.0780/1.0750, potentially indicate some signs of a mean reversion rebound on the euro dollar that could take shape after these 3 weeks of steep oversold condition and overextended decline condition that has really played out. All right, so now with that, let us now focus on the hourly chart for today's key levels to watch. So on the hourly chart, still no change. I cannot tighten my key short-term pivotal support to last Thursday exposed ECB low at 1.0814, because it hasn't surpassed above the 200-day moving average yet, which is our first resistance that we highlighted on Friday at 1.0870/1.090. So still no change, still maintain that intraday bullish bias for this potential short-term mean reversion rebound to play out. Still using the 1.0780/1.0750 as my medium-term pivotal support level for today. Only a clearance above 1.090, pardon me, 1.090, that I could tighten my key short pivotal support for today at 1.0814. Okay, so level still remains the same because in today's Asia session, it hasn't cleared above 1.090. 1.090. So 1.0870/1.090 is a range, is a kind of a band, the upper band. So only a clearance above the upper band potentially increase the conviction of this potential short-term intraday bullish buyers for today to expose the next near-term resistance on the euro dollar at 1.0950. All right. However, if price action starts to break down and it starts to surpass below 1.0750 on today, then this intraday bullish bias will be invalidated to see the continuation of the impulsive downward sequence of this multi-week corrective decline since the high of 25th of September this year to expose the next near-term support level at 1.0710, followed by 1.0670 in first step, which is this congestion, this minor swing low of 14th of June to 27th of June this year. Okay, so that's for the euro dollar. Now, turning our attention to the sterling dollar. So the sterling dollar continues to hold above the 130/1.2980 medium-term pivotal support level, which we highlighted on last Friday. RSI continues to remain positive as it's going to trace up a series of higher low, hasn't hit the overbought region yet. So net overall, short-term intraday momentum continues to remain intact. So still using the 130/12980 medium-term pivotal support level to maintain our intraday bullish bias on the sterling dollar. So first resistance level remains unchanged at 131.07. Only a clearance above 131.07 potentially expose the next near-term resistance level coming in at 1.3160, which confluence with the 20-day moving average, acting as a similar resistance level as well at 1.3160. Only a breakdown with hourly close below 1.2980 will invalidate today's intraday bullish bias on the sterling dollar to expose the next near-term support level at 1.2940 and even 1.2860 next. So 1.2860 is in fact the former congestion area here, former minor swing high breakout now turns into a pullback support. Previously was congestion between 30th of July to 15th of August this year. Okay, so that's for the sterling dollar. Now, turning our attention will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar, for those who recall, on last Friday, we flipped back to a intraday bullish bias, holding above the 6670/6660 short-term pivotal support level. Hourly RSI continues to display a series of higher low above the 50 level mark, hasn't hit the overbought region yet, so indicating some form of short-term bullish momentum potentially still remains intact in the Aussie dollar pair. So first support level to watch out for will be this swing low here, last Friday US session swing low at around the 67 figure level. So still no change since it can't break above our first resistance that we highlighted on last Friday. So I don't want to put it so tight at 67 figure level as my short-term pivotal support level. Still using 6670/6660 as my short-term pivotal support level, maintaining that intraday bullish bias on the Aussie dollar. So first resistance level to watch will be 67.40, followed by 66.70 next on the Aussie dollar. Only a breakdown below 66.60 with an hourly close below it will invalidate today's intraday bullish bias to see the start of another impulsive down move of the minor corrective decline sequence to continue to expose the next near-term support level at 66.35, which is correspond to the 200-day moving average. A breakdown below 66.25 sees the next support coming in at 65.95/65.75, which is defined by the minor swing low area over here of 15th of August this year. So that's for the Australia dollar. So now turning our attention will be the dollar yen. Still recall that the dollar yen on Friday, we flipped to a bearish bias. Why? Because of various we call it a bearish technical element that has really emerged on last Friday. So for those who want to recap, can take a look at last Friday daily dose, which I already posted on the OANDA Asia Pacific YouTube channel. So just to recap why we flipped to a bearish bias on last Friday, because of the emergence of this red line over here. So what is this red line? This red line over here, notice that it's a converging red line where the slope of the linking the higher high is lesser than the slope linking the higher low. So we call that a bearish divergence wedge configuration that has taken shape on last Friday, and in today's Asia session it actually managed to break down below the lower limit of this bearish ascending wedge configuration support level over here. All right, so no change, still maintaining our intraday bearish bias using the 150.20 as my short-term pivotal resistance level. First support level to watch 148.95, a breakdown below it exposes 148.10 and potentially even 147.20, which confluence with the rising 20-day moving average as well. Only a push up with an hourly close above 150.20 will invalidate today's intraday bearish bias on the dollar yen to see the continuation of this move on this rebound, 4 week of rebound up move to test the long-term pivotal resistance zone at 150.90, followed by 151.50 slash 151.95, which correspond to the 200-day moving average. And very important, this dotted gray line. Why is this dotted gray line? If you go to the daily chart over here, is in fact the former major ascending channel support drawn from the low of 16th of January 2023, now turns into a pullback resistance on the hourly chart, which is clear very clearly at the 150 slash 151.95 level. Okay, so that's the technical outlook on the dollar yen, still maintaining that intraday bearish bias using 150.20 as my short-term pivotal resistance level. Okay, so that also sum up the intraday technical outlook on the various major FX pairs. So now turning our attention will be the short-term intraday technical outlook now on the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index still no change. Today over here it managed to did a push down and managed to help right exactly at the 200-day 20-day moving average that managed to surpass on Friday over here. All right, hit push up, but it still can't break above this stubborn intermediate resistance that I've been highlighting last week, 20,850, to give the boost a higher chance of seeking a higher level near-term resistance level. So net overall, I'll be using a short-term pivot. Okay, let me put it over here. Okay, so today's first support level to watch will be very close to the 20-day moving average, which is also very close to today's intraday current Asia session low at 20,440. But this particular very important support level still remains as my pivotal support for today, because I don't know, tighten it so tight to 20,440, just in case of any whipsaw in between. So this 19,790 slash 19,445 medium term pivotal support will still be my pivotal support that will be used for today to maintain that intraday bullish bias on the Hong Kong 33 index, which is i.e. the Hang Seng Index. Clearance above 20,850, that means i.e. an hourly close above it, 20,850, will increase the we call it the, or reinforce the potential intraday bullish bias for today, to see the next near-term resistance coming in at 21,550 in the first step, followed by 22,320 next. Only a breakdown with hourly close below 19,445 will invalidate today's intraday bullish bias to kickstart the extension of this corrective decline phase that is in place since 8th of October, to extend it further on the potential downside to expose the next near-term support level at 18,320, 18,230 next, which also correspond very closely to the rising 50-day moving average, and also the 200-day moving average coming close to this level as well at 18,230. All right, so that sum up the intraday technical outlook on the Hong Kong 33. And one more positive technical element to share with you all is the hourly RSI continues to shape a higher low, okay, right above the 50 level mark as well, indicating that some form of short-term bullish momentum still remains intact on the Hong Kong 33. Okay, now turning our attention will be the Japan 225. So on the Japan 225 or the Nikkei 225 remains stuck within this sideways range that we highlighted on last Friday, still using 38,740 as my short-term pivotal support level, which is the lower limit of this complex sideways range. Still maintain that intraday bullish bias, but however, the first resistance to watch out for today is only maximum up to 39,580, which is the upper limit of the range. Okay, maybe it's a zone over here. Okay, let me put it. Okay, 38,004, 39,430 slash 580. Okay, so it's 39,430 slash 580. So this is the maximum potentially up to the upper limit of this range, still maintaining that intraday bullish bias while you continue to trap in this complex range configuration, holding above the rising 20-day moving average as well, which correspond closely to the 38,740 short-term pivotal support. However, a breakdown with an hourly close below 38,740 short-term pivotal support will invalidate today's intraday bullish bias to kickstart another round of a minor corrective decline sequence. Next near-term support level to watch will be 38,360, which correspond to the 200-day moving average. A breakdown below it sees 37,850 next, which correspond to the rising closely with the rising 50-day moving average. All right, so that's sum up the intraday technical outlook on the Japan 225. Now, turning our attention to the German 30, which is one of the major European stock index. The German 30 continues to evolve in a series of higher high and higher low. So thereafter, still maintaining our intraday bullish bias, but it still can't surpass our first resistance that we highlighted earlier on last Friday, which is currently the all-time high area at 19,690 slash 19,755. So net overall, we will still maintain that intraday bullish bias, but we do not want to tighten the key short-term pivotal support to too tight at this 19,410. So this 19,410 will still remains be our first support level to watch, but still using 19,320, which is the previously congestion area here, now turns into a pullback support and also being a confluence with this rising 20-day moving average as well. Okay, this rising 20-day moving average as well. So net still no change. As long as any potential pullback managed to help above 19,320, we will still maintain that intraday bullish bias on the German 30. Above 19,755 sees the next intermediate resistance coming in on the intraday basis at 19,320 next. All right, 19,320 next. Then, however, if price action starts to break down below 19,320, then this intraday bullish bias will be invalidated to kickstart another round of minor corrective decline sequence, exposing the next near-term support level at 19,130 and also potentially even 18,960, which is the minor swing low area of 8th of October, and also confluencing very closely soon with the rising 50-day moving average. All right, so that's for the intraday technical outlook on the German 30. Now, turning our attention will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to actually stage that rebound over here on last Friday. So what you could see over here is that still no change. On Friday, it managed to come down, hit our first support level, did a bit of whipsaw below it, but didn't break below the pivotal support that we highlighted on last Friday, a Titan one, which is 42,960. So no change, still using for sure this 42,960 will be indeed our short-term pivotal support level to maintain in any form of any potential pullback today that if it were to take place. So still maintain that intraday bullish bias as long as 42,960 short-term pivotal support holds. First resistance level to watch will be 43,540, remains unchanged, followed by 43,920, which is the 0.764 Fibo extension taken from the low of 11th of September, and the 1.236 Fibo extension taken from the low of 5th of August. All right, so these are the next two resistance level to watch out for. However, if price action starts to break down below 42,960, then today's intraday bullish bias will be invalidated to kickstart a minor corrective decline to expose the next near-term support level at 42,630, which correspond to this rising 20-day moving average. A breakdown below 42,630 may expose the next near-term support level at 42,180 next. So that's for the US Wall Street 30, still maintaining our intraday bullish bias. Now, lastly will be the Nasdaq 100. So the Nasdaq 100 continues to churn sideways, still holding above the 20-day moving average and our short-term pivotal support that we highlighted on last Friday at 20,155 slash 20,000, the psychological level. Okay, this zone over here. So since it can't break above this first resistance level at 20,406 level that was tested on Thursday and tested on last Friday, we can't tighten our key short-term pivotal support level. So still using 20,155, pardon me, slash 20,000 as my short-term pivotal support zone, still maintaining that intraday bullish bias on the Nasdaq 100, but it got to break out fast above 20,407 to allow the next near-term resistance level to come in at 20,615. 20,615 is being defined by this minor swing high on 16th of July. All right, so far Nasdaq 100 has been underperforming the Dow Jones and the S&P 500 as it failed to continues to break new fresh all-time high since the July high of 20,790. So however, if price action continues instead of going up and it has an hourly close below 20,000, then today's intraday bullish bias will be invalidated to kickstart a minor corrective decline sequence to expose the next near-term support level at 19,750 slash 19,630, which confluence with the rising 50-day moving average and as well as the lower limit of this medium-term ascending channel that is in place since 5th of August low. All right, so that sum up the intraday technical outlook on the major stock indices. Now let us turn our attention to the commodities market, starting with gold XAU slash USD. So I did mention earlier, gold XAU slash USD continues to print fresh all-time high, and right now it's coming very close to our predefined resistance level that we highlighted on last Friday, which is at 2,735 slash 2,737. And given that the hourly RSI is coming close to the overbought level, so far there is no bearish divergence. Price action going to ship higher high, but it's coming back. It's already come close to this kind of a very previously extreme overbought level over here. Okay, very close to this overbought level. Hit then before the price actually exit from the overbought extreme overbought level, so that's around 77 level. All right, so since it's coming very close to the this kind of a relatively extreme short-term overbought level that is in place since 25th of September, potentially there could be a chance of a minor pullback, and plus it's also coming very close to our first predefined resistance level at 735, 2,735 slash 2,737. So potentially there could be a minor pullback taking shape. First pullback support level to watch will be last Friday minor swing low at 2,702 level, but I don't want to put this level too tight. I will use a slightly lower level at 2,683, a tighten short-term pivotal support level for today. So as long as this minor pullback didn't surpass below 2,783, we also confluence with the rising minor ascending trend line support that I drew from the low of 10th of October. We will still maintain that intraday bullish bias on gold XAU slash USD. The next resistance level to watch will be 2,760 slash 2,763, which is a confluence of Fibo extension level 1.618 over here, taken from the low of this 26th of July over here. That's give rise and to okay over here, yep, at this juncture. And if I were to do another Fibo extension from the low of 19th of September all the way up to this swing low here, okay, it's also coming very close to 2,774 as well, right? Pretty much close to this region over here. So only, and also most importantly graphically, is the upper limit of this medium-term ascending channel that I drew from the low of 8th of August. All right, so net overall still maintain that intraday bullish bias as long as 2,683 holds, short-term pivotal support holds in any form of a pullback. All right, so but however, if price action starts to come down and break below 2,683, but hourly close below it, then this minor corrective pullback may unfold into a much more deeper corrective pullback to revisit the next near-term support level at this 2,668, followed by 2,656 slash 2,500 2,656/2,645 level, which correspond to the rising 20-day moving average as well for gold XAU/USD. Okay, so now turning our attention next will be the West Texas crude oil. So the West Texas crude oil continues to break down below our Titan short-term pivotal support at around 70 dollars and 10 cents per barrel, but managed to find support at this minor ascending trend line from the low of 11th of September, and the price action managed to exit from the oversold level. So kind of mixed element right now. So I will have a neutrality stance on the intraday basis for West Texas oil. That means neutral, sideways between 71.60. That means this is a minor range resistance that is in place since 15th of October that can't surpass, and also 68.70, which is close to the lower limit of this, close to the minor ascending trend line taken from the low of 11th September. All right, so neutral between these two range, 71.60 and 68.70. Unless price action has an hourly close below 68.70, then this extension of this corrective decline that is in place since 8th of October may extend further to expose the next near-term support level at 67.55/10 and even 65.90/70, which is the minor swing low area of 11th of September and 12th of September. Right, so that sum up the intraday technical outlook on West Texas oil, and as well as the intraday technical outlook on the major cross asset classes. So before we go for today, let's take a look at the calendar. What are the key data to look out for today? So for today is a rather quiet session on Monday. So no key data to look out for in the European session, unless for kind of a second tier data, not so important, is the German economy PPI data, producers price index data, where market is still expecting it to show signs of a deceleration, negative 0.8% year on year based on the forecast for the month of September. So that will be up at 2 p.m. Singapore time. So that could potentially impact the German DAX and as well as the euro dollar movement. And during the US session, we do have one Federal Reserve official speaking, Fed Logan, speaking at 8:55 p.m. Singapore time before the start of the 9:30 p.m. US stock market trading session. And thereafter, you have Conference Board Consumer Confidence Conference Board Leading Index, Conference Board Leading Index. So it's one of a growth index that we should take note of in terms of economic data for the US out at 10 p.m. Singapore time. So that could potentially impact the major US stock indices as well. And thereafter will be a rather quiet session. During the early morning Asia session, we have Fed Kashkari speaking, Federal Reserve official Kashkari speaking at 1 a.m. Singapore time. Then thereafter, 5:05 a.m. Singapore time, Fed Schumik speaking. All right. So thereafter, so today will be more of a kind of a Fed speaker instead of key economic data releases in terms of the calendar agenda for today. So with that, that sum up today's Daily Dose of Market Insights. With that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.